Hey guys, All in Crypto here, and welcome back, ladies and gentlemen, for another YouTube video. This is just going to be a short and sweet one. We're really going to cover the events of yesterday's non-farm payroll, the effects that this has had on the markets. We live in this kind of upside-down universe at the moment, in regards to good news actually, translating to bad news for markets. And we're going to talk about that, and we're going to talk about why a massive increase in jobs, non-farm payroll jobs, has actually led to the market selling off yesterday. And the real reason is because, Jerome Powell and the Fed are really looking at the labor market to support their very tight or restrictive, I should say, monetary regime in terms of interest rate hiking. And this report, this data essentially gives them the confidence to continue to up rate hikes, potentially at a more aggressive manner than a low non-farm payroll number would have given them. And this, of course, has transpired to markets. And there's lots going on. Yesterday, we looked at the yield curve. This is still a major concern for me. And what happens next week with this yield curve is really going to set the pace, because the yield curve has been a very good predictor of economic turmoil, whether that be the dot-com boom, the crash of '89, the 2008 financial crisis, the whole pandemic, or the Russia situation. We're now at some, historically low levels for the yield curve. And this is cause for concern. This is people sort of hedging their bets and looking at potentially a bigger recession than we could potentially be or have been expecting. So there's an awful lot going on, and I'm going to show you a number of tweets. We're going to be pulling up some tweets from Macro Alf, who's well worth a follow, by the way, guys. This guy is one of my go-tos for navigating the kind of environment that we're in, the macro environment that we're in, and the macro environment really is driving the Bitcoin story. You guys know that I think ultimately, eventually, we do see lower prices and put in lower prices for Bitcoin. I think we go below 17K eventually. And I think the overall market will, of course, come down with it. And I think there's a lot going on with the stock market. I believe that this is just a relief rally for the stock market. We've looked at quite a few things in relation to the stock market. This kind of pivotal point, you're right at your 30 moving average. And it is typically going to act as your resistance. And you can see you've rejected off it. You've also ran into the neckline of your head and shoulders. Does this roll, and does crypto go with it? This for me is nothing more than a relief rally until proven otherwise. And we haven't seen any kind of significant volume to suggest that, other than short covering, other than, people trying to capitalize on this relief rally, we haven't really seen that accumulation take place that we'd like to see from your big players with large volume behind it. It's really supporting this as the start of the new bull market. Is there possibility that we go higher? Absolutely. We've said, look, there is the potential that you sort of try and make your way back up to that 26K range. But for me, it's dangerous to be looking at this. We're still asking ourselves the big question, risk to reward. Does the reward outweigh the risk of being an investor right now and putting all your capital back into the cryptocurrency market? I think the risk far outweighs the reward in this case. We also had the dollar gaining strength on the back end of this. Again, an indicator that this high jobs report essentially is giving the Fed the backing to continue with their monetary regime, because inflation is going to still stay persistently high. Even if we had a zero print on the CPI for the next, into the end of the year, we'd still finish, I think, near 7% inflation. And that's just simply unacceptable from a Fed's point of view. And they're going to really fight this at all causes, and they're fighting it through interest rate hikes, which really take money off the table. Remember, markets are driven by liquidity, so you have liquidity getting taken off the table from a monetary standpoint in terms of the dollar catching a bid and liquidity becoming more expensive, and then you also have, I believe, retail purchasing destruction or retail demand destruction. Based on high inflation, based on bills becoming unaffordable. It's just not the time that we want to be getting into markets, is the short of what I'm trying to say here. And again, this was pretty crucial data. Non-farm payroll rose to 528,000 for the month, and the unemployment rate was 3.5%, easily topping the Dow Jones estimates of 258,000 and 3.6% respectively. So all the estimates, this has overshot them insanely. And again, this kind of calls for potentially the Fed to have the confidence to go ahead and do what they're doing, because they're not. It's the main stat that really they look at is the labor market, and are we seeing destruction in that? Are we seeing mass layoffs? We are seeing layoffs. I think this is something that snowballs. We've looked at, and I'll just pull this tweet up actually from Sven Hendrick. The Northman trader is what he goes by. You can see over the last 67 years, very low unemployment has shown itself to be one of the most dangerous times for the economy, especially in context of high inflation. And this is, we showed this with the market sniper. It's just another chart of showing it. Look at where you're at. When this starts to uptick, and there's a huge correlation here between the unemployment rate and the stock market. So when your unemployment rate is at record lows, stock markets is typically at highs. And then when you get that shift, that's when the real downturn starts. And I do believe that, we're in a 2008 period, and also a sort of 2000s period. This is what I think we have to come. We've got that kind of hangover that we're about to all endure, or markets are about to endure, from the party that was March 2020 onwards in regards to inflation. I want to be bullish on crypto. I am exceptionally bullish on crypto over the long term. I just think that over the next end of the year into next year, we've got a bit of a sticky time period ahead of us. And I think that's where all the opportunities are really going to lie for somebody like myself, who is majority in stable coins right now. And could we be wrong? We still have exposure to crypto. We absolutely could. But this is where I'm going to want to be accumulating into, the further downturn that I do envision. There's no clear bottoming structure here whatsoever. We're going to do a couple of videos on talking about where we're looking to buy and what I'm looking at in order to start putting money back into markets. I'm just not seeing it yet. Again, ask yourself the question, risk to rewards. What really, what's the real reward here in opposition with the risk? So wage growth also surged as average hourly earnings jumped 0.5% for the month and 5.2% from a year ago, higher than estimated. Still not catching up with inflation though. This is what people have got to realize. And remember, the inflationary stats they give you, I think, are largely underestimated. So traders are now pricing in a higher likelihood of 75 basis points hike for the next Federal Reserve meeting in September. So potentially, we've got a kind of sigh of relief, I think. All the bad news actually transpired to good news. The recessionary news, or not recession, whatever they're calling it now. They're going to start calling it a whoopsie or a hiccup or something like that in the future. They've always changed the narrative. So a recession was called a depression before that, and prior to that it was called a panic back in the 30s. And they've kind of softened it out. The world is getting snowflakerized, and I'm sure we can all see that. That's not a hit at anybody who or a dig at anybody who's soft. I see the world going in a very soft direction. We've become very dependent on government. We've become soft in many ways. There's, and this is something that I think about on a greater scale. It's not really crypto related. Just some thoughts that I have that every now and then I share with you guys, is that we're far too dependent on government. We're not self-reliant, and this is part of the thesis of Bitcoin was to move away from that sort of government control of money. I think that there's areas that we need to decentralize that are beyond money. Food, for example, we're very, very dependent on the government in regards to that, in regards to shelter, and it's getting well off topic. Just food for thought. A bit philosophical for a Saturday afternoon. So massive labour market reports with everything the Fed does not want to see. Huge beat and prior number revised up to Hourly earnings up, wage picking up, labor force participant rate down, less labor supply. A data-dependent Fed now has to be very, very hawkish. Not good for risk assets. If bad news was good news, Fed will pivot, blah, blah, blah. Good news must be bad news. A more aggressive Fed should lower inflation expectations while nominal yields remain well-behaved. Higher real rates. Last time 30-year yields were at 100 basis points. The SPY, basically the S&P, was at 3,700 to 3,800. So it's going to be an interesting time period. You know, could we be wrong in our thesis that we think markets are going down? We've got a lot of stick for it. We've lost a lot of popularity actually as a channel for having a bearish short-term outlook. But at the end of the day, you know, we were getting largely out at 44K. It's all on my Twitter. All the videos are still up there. Yes, we weren't the first out, but we, I think, have saved quite a few people quite a lot of money. And that's, at the end of the day, the goal of this channel is to be honest with what I see, to be honest with you guys, and try and help you sort of navigate things as somebody that watches these markets daily and is extremely invested in the cryptocurrency market. You know, still in stable coins now. We're just waiting to get back in. And I think there's a wall of worry that markets are trying to climb right now. And does SCAR Chuck move faster off the cliff into the wildebeest, the stampede? So that's really all I've got for you guys. Bit of a long-winded one, lots to cover. You know, this is why markets are doing what they're doing. And again, just a real testament to something that we've been saying for a while now, that the macro story, guys, it's not crypto moving and dancing to its own tune. It's crypto dancing really to the tune of the Federal Reserve and the sort of wider geopolitical economic landscape. All I've got for you in this one, guys. If you've enjoyed the content, like is always appreciated. So is a comment, and I look forward to seeing each and every one of you in the next YouTube video. Thanks a lot for watching, ladies and gents.